60% stocks, 40% bonds. Well, everything else has changed, including what the industry can do in terms of limiting losses. So we're suggesting that real estate and stocks may do what it's done before, be off precipitously and take longer to recover. The areas that we do like are outside of traditional investments, outside of cash, outside of homes, outside of stocks, okay? It might look like infrastructure. It might look like manufacturing companies.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, we've had 2 back-to-back years of 20+% gains in the stock market. Are the good times going to roll in 2025, or are we seeing now perhaps the beginning of the January effect? In January, so goes January, so goes the market. Well, our good friend John Grace is with us now. John, it's great to have you back on the show. And, well, tell us here for Investors Advantage Corp, your company, what's our advantage here? Do we prepare in times of war, we prepare for peace. In times of peace, we prepare for war. But sometimes it's neither peace nor war. What do you do?
We prepare for both. As an old Boy Scout working on my Eagle Scout badge, which I managed to attain, yes, it's all about be prepared. That's exactly what the advice is, and that works 24/7. And I appreciate being on again, Kerry, and I see so many people, we get complacent. We get accustomed to, well, this is the way it's been, so it's just going to continue. I mean, and we've been here before in the 90s, as you may recall, and that was a very good run. And then I believe it was Chairman Greenspan at the time who talked in late 1996 about a phrase he coined called irrational exuberance. And of course, he took a lot of flack, and people told him he was completely out of step because the Dow and the S&P at the last half of the 90s doubled in value. 100 went to $200,000. That's pretty good. The NASDAQ quadrupled. 100 went to $400,000. But then I think it was about March 2022 that suddenly what he had suggested suddenly came into favor, and now he was welcomed back to the dinner table. Right, that's where we saw the financial or the .com crisis happen. Nasdaq was off. Was it really over 80%? And in my industry, I've only been at it since 1979. Kerry, we always say, well, it always comes back, and it did. Nasdaq did come back. It just took 15 years, I believe, assuming you did not sell a share. You didn't need any money for 15 years, and then it comes back. So the way I look at it is, let's be ridiculous and suppose something like what happened in 2000, 2002, 2008, it happens again. Only this time, we've got more people than we've ever had before. It was 11,000 people a day turning 66 this year, I believe. And a lot of people reaching the age where they must take required minimum distributions that only increase every year as a percentage, no matter what your account does for you or to you. Well, now it seemed to me that we'd want to really look at what can savvy investors do to limit their losses. If you have to take the withdrawals and you must pay the taxes, as you do from traditional retirement accounts, and those withdrawals rates go up a little bit every single year, no matter what, now's the time I would submit to look to see where the exit doors are. Where are the strategies for limiting the losses, as opposed to believing you have to live with the losses. And, we may not have enough time to have those losses offset by the gains, assuming the gains come. So it's all about limiting those losses, no different than you don't want the Hail Mary pass at the last 2 minutes of the game to get back in the game, and then the game's over and you're crying when you know.
Yeah. Well, another popular quote out there is everyone has a plan until they get punched in the face, right?
That's correct. And I love George Patton's. I love quoting George Patton because of what he said. If everybody's thinking alike, then somebody isn't thinking. I think that's true. That's what I think. I think he got something there.
Yeah. So do you run for the hills? Is that what you do?
Well, see, as I say, when I would take my family to the movies, oftentimes we go in and throw our clothes or our jackets in the seat and go back for popcorn. So that would give my sons just enough time to do what I asked them to do every time they go into a building, and that's look for the exit doors, the emergency doors. And when we come back, I would stand. I would make sure they could not see the exit doors, so that they get to their seats, and I would stand in their way and say, "Now tell me where the exit doors are before we go back to our seats." And they would, because they knew the drill, and that's what it took to be able to sit down and enjoy the movie. And that's my point. This is the time for investors to determine how much loss can you live with. Is it possible you might be able to limit your losses within your parameters? For example, if let's say 2008, the market's off 37%, and the more traditionally managed mutual funds, the equity funds, are off over 40%. Is it possible that your account might have been off less than 50%? Okay, so you own $1 million, make it simple. Instead of being off 370 overall market, over 400,000 in most of stock mutual funds, so many of them. If your account was off less than 20%, would that be a good thing? Would that be following the adage of, if you find yourself in a ditch, stop digging? I think so. If you're down 200,000, that's not good news, but that's better than being down 400,000. And that's my point. What can we learn from the past and see what we could do to limit our losses, if indeed they happen to be baked into the cake? If the real estate market drops precipitously, if the stock market drops dramatically, the question becomes, in advance, how are you keeping your assets from being burned up, like we look at the fires going on in Southern California right now, where nobody imagined thousands of homes would be burned up, and most of them were completely unprepared.
But, in everything that happens in life, there are winners and losers. Even in California, the contractors who are going to be retained to rebuild these properties, hopefully, the governor has said he's suspending all building regulations and permits and everything. Maybe not regulations, but permitting, so that could be accelerated. Deregulating California is like something I never thought I'd live to see. But point being, it's something you have to think about.
Well, and look in advance for it. There's a great story of a gentleman in the Pacific Palisades who forethought what might happen, and he put sprinklers on his roof. He used several large hoses to draw water from his pool to sprinkler around the house, and then he had to exit stage left at the last minute. And he was convinced that he would come home, as he's seeing all these homes that are just destroyed. His was still standing, and he was able to help other people. And of course, that's the point. The question becomes, how can you play the game where it might be heads you win, tails you win? You want to be able to tell your story as he can, as opposed to the folks crying their hearts out, and our heart goes out to them, who lost everything. It's completely unimaginable, but that's why it's so important to be prepared.
So, off topic a little bit, but really on topic, natural disasters, unavoidable.
Mm-hmm.
But it's the reaction to them, and to the extent that you can prevent or mitigate them, that really shows leadership.
Yes.
Maybe California will learn something from what's happened here, that their leadership is totally not up to the task of.
Well, and maybe we should learn. We don't keep building on the edge of canyons. We don't keep getting closer and closer to the ocean for the view. That's fine when everything's working well. Not so fine when the fires come rushing down the canyons in reverse direction.
There was a hurricane.
I happened to come across a UCLA study. This was just about the time we were discovering we're drinking the same water, breathing the same air, flying the same airplanes, and here comes COVID. Apparently never saw that one coming, right? But what the UCLA study showed is, one, the state, when we developed the aqueducts, our leadership happened to choose the most wettest 100 years to study. Was that by intentional? Was that a mistake? Maybe we should have studied The 100 years that were the driest, well, we made a decision based on the wettest. And what the study went on to reveal is if you look at the pattern long before most of us were on the planet, including our parents and maybe their grandparents, the history in California, they said you want to learn from the long-term history. Californians, get ready for more floods, get ready for more fires. It's the way California is built. And then they had a picture of Governor Leland Stanford being rowed in Sacramento to his inauguration. Hard to believe, that kind of thing could happen, but it has. And I would say, Kerry, I think part of the problem that we have is we don't learn from history, my friend, because too many of us are so busy repeating it.
Yeah. Yeah. Well, there's an old saying, the only thing we learn from history is that we don't learn from history.
I wish that wasn't funny because it's true. But sometimes you got to laugh at the truth.
Hey, well, I told you I'm a quote collector. So, hey, I love doing these interviews with you. If there's 3 sectors for the coming year that you think are going to outperform the market or at least keep up with it, what are they going to be?
Great question. The model for the securities industry from day one for the last, I don't know, at least the 44 years I've been in the business, 60% stocks, 40% bonds. Well, everything else has changed, including what the industry can do in terms of limiting losses. So we're suggesting that real estate and stocks may do what it's done before, be off precipitously and take longer to recover. The areas that we do like are outside of traditional investments, outside of cash, outside of homes, outside of stocks, okay? It might look like infrastructure. It might look like manufacturing companies, okay? Owning the warehouses, all this stuff has to be distributed. How about owning the land under those warehouses? That's probably going to be a constant. How about being in student housing? Good clients who own property near USC. He's an engineer, rocket scientist. She's a broker. They have real estate that they own as rentals near USC. They tell me USC reports they have 8,000 rental units with 40,000 people on the waiting list. I bet that waiting list just went up. My point is, if we own those kinds of real estate investments, you got a lot of demand for it, and you can manage the market with all of that demand. And I would suggest being outside of Southern California, out of California altogether. The other area that I really am fond of, Kerry, that I think has a lot of promise, and a couple of vehicles have been around for over 7 years now, is owning data center infrastructure. All the real estate necessary for all the artificial intelligence that we're getting accustomed to embracing and using. Well, it requires 300,000 square foot buildings, again, outside of California. Solid yield, solid returns, net to the investor based over the last 7 years. That's one of the things that I think will hold up well no matter what happens in the economy, what happens in Washington, what happens in Sacramento.
All right. Well, I don't know. The data center thing looks like could be a modern day gold rush. We know what happens to gold rushes, John.
To your point, Levi Strauss is still a name we know, right? And he got famous doing what? He wasn't going after the gold. He didn't do picks and shovels. He did clothes. And I think they've been around for 1825, something like that. I think you made a nice parallel there. Look for the where the need is not going away. It has nothing to do with demographics so much. We're going to be using all this technology. We may as well own the real estate that has to be in place to provide all this technology.
How about electric utilities? Looks like we're heading for shortages in key markets. I know one in Virginia where probably the biggest data centers in the world that you never heard of in the Langley vicinity. You can't build a data center there without a 2-year reservation.
Right. Yes.
So, and what does it mean for alternative energy sources? Are we going to see a boom in solar and wind? Certainly we're seeing a boom in battery storage.
Yes, sir. That's going to continue. No doubt about it. A lot of opportunities. But just as I say, I think we have to expand our thinking. If we look at Yale endowment, was it like $40.7 billion? What's astonishing to me, Kerry, is their exposure to U.S. stocks is, last time I looked, and I tend to look once a year, it was around 3%. I didn't say 30. I didn't say 40. I didn't say 60. I said 3. And what I find is they have maybe 6 or 7 different assets legs, if you will, under that portfolio stool for more stability. And if you spend some time on their site, they explain what they used to do back in the 80s, what they're not doing anymore, which is very different than the securities industry. They also represent, this is their report, not mine, that they didn't lose money in 2008. So I'm submitting that, we can learn from the best and the brightest. We can't replicate what the endowments and the institutions do, but they have been in private credit and private companies and private equity long before retail investors. Those are some of the areas we want to follow the best and the brightest to see how we might put some more legs under our portfolio stool so that it's less wobbly. A little more.
I also remember reading an article that Harvard had gone all in on payday lenders too.
Mm-hmm.
So,
they do their homework.
Yeah, but I guess it was good. Well, I guess it was good until it wasn't, like so many other things. Hey, John, just tell us how we connect with you, how we find you on the web, and what you can do for us.
Investors Advantage, to your listeners, Kerry, I'd be delighted if they have some questions they'd like to talk about what we're discussing. We'll give you, allow 15 minutes, right, to see if there's something we can do, a way that you might be better prepared, to see how you might limit the losses. Maybe there's something, maybe not, but that's without any cost or obligation. And then if it makes sense, we can help prepare a financial plan to help people see what it takes to get from here to there and arrive on time safely to make work optional. But right now, we really are on a mission to show investors, as we were in 2007, by the way, sometimes it's better to be lucky than good, to limit losses. That's what I think is so crucial. The industry simply says you have to live with your losses. The good news is that is not true, but too many of my peers haven't really been advocates or being about the business, showing investors what might you do to limit your losses. Happy to spend 15 minutes with your audience.
Yeah, ex-spouses say the same thing. But hey, we got a link in the show notes to this interview on Financial Survival Network. Just click it. It'll take you right to John's site. And if you got a question for John, myself, shoot me an email. While you're on the site, we just ask you to please sign up for a free newsletter like 65,000 other FSN community members have done. John, appreciate you coming on the show. Best of you, best of 2025 for you and yours. We'll talk to you again real soon.
Look forward to surviving and thriving in 2025. Always good to be with you, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.